there's silver coming in the door from sellers, but as soon as it comes to the door, it's always sold instantaneously. We've got a disconnect between Europe, where there isn't any silver. People are crying out to buy it at the shops and they can't get it. Shanghai, the price is very high. But then you've got the COMEX price, which is the official price. So which one is it? Which one's real? Try and buy some silver at the COMEX price. Unless you're very sophisticated, you have an account at COMEX, you can't.
Silver market has been manipulated by the big banks.
The large bullion banks buying some silver at COMEX, loading it up on a plane, flying it to Shanghai and delivering it to the Shanghai silver market the next morning to take advantage of the difference. It seems that that's not happening at the moment. But is it manipulation?
So what about the silver miners then, Clive? Are they still attractive?
If your portfolio, when you look at it, is a sea of red, minus, 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 what are you? You're a lousy investor. When you have a winner, never sell all of it. You want to take some profits. Don't say, gosh, it's so high, I've got to sell it all. Sell a little bit. What about your losers? Let's say you've bought silver at 120 and it's now 100. I was speaking with a friend at a very large, I think it's probably the largest gold and silver chain here in Switzerland. They sell bullion metals. For weeks and weeks, they've been completely out of silver. Zero. They can't get it. There's silver coming in the door from sellers, but as soon as it comes to the door, it's always sold instantaneously. So there's far more buyers of silver than they can get in the door from sellers, and they can't get any manufactured coins or bars. So that could be out of silver. As far as gold is concerned, all the gold coins have gone as well, and the small bars have all gone. All they've got left are 250 gram, 500 gram and 1 kilogram bars. That's it. They're out. But that's painting a very different picture from many bullion shops in the United States, where the story is the bullion's coming in the door and they can't offload it to the customers, and they can't offload it to the refineries. So we've got a disconnect between Europe, where there isn't any silver and people are crying out to buy it at the shops and they can't get it, and the United States, where the shops all seem to be overloaded with silver coming in the door.
Shortages in one region and oversupply in another usually signal liquidity stress, not simple demand shifts. As Clive Thompson describes, physical silver demand in Europe appears constrained while US inventories sit idle, suggesting supply chains and financing conditions matter more than headline prices. Global metals flows often tighten when credit conditions change. Similar patterns appeared during the March 2020 liquidity crunch, when physical premiums diverged sharply from futures pricing. Investors should watch dealer inventory trends, not just spot prices, because physical demand signals real market stress. Next, Clive Thompson hints that price discovery itself may be breaking down.
And then even sell it to you at below the silver price to get some money, because they've run out of money, they can't buy any more, and they need to sell some below the price to anyone who's willing to buy it, just so they could keep buying from their customers who could bring silver back in. So we're really in a world where the silver price, you're not really sure what it is. It seems to be different prices in different places now.
Yeah, that's interesting.
We've got the European, the Europeans don't have any. The Shanghai, the price is very high. United States, if you go to a coin shop, it will depend on if they've got any stock or not any stock, but it looks like they all have. And it looks like many of them would sell it to you below silver, spot price. And then you've got the COMEX price, which is the official price. So which one is it? Which one's real? Try and buy some silver at the COMEX price. Unless you're very sophisticated, you have an account at COMEX, you can't.
Yeah, I wanted to ask you about that actually, in terms of the discrepancy between the Shanghai price and the London and the COMEX price.
When the same asset trades at different prices globally, liquidity, not value, is usually the culprit. Clive Thompson is pointing to a fragmented pricing system where retail, futures, and regional markets no longer align, something rarely seen outside stressed commodity cycles. In 2008 and again in 2020, physical metal premiums diverged from futures markets as financing tightened and dealers needed cash flow to survive. For investors, this means spot price may not reflect real acquisition cost or true demand conditions across regions. Portfolio decisions based solely on exchange pricing can miss underlying stress signals. Next, Clive Thompson explores why global arbitrage may be failing.
Because that's been really large, hasn't it? At times, what's actually going on there? Do we know exactly what's happening?
Some people say there's a tax difference in Shanghai, but I think they've got the wrong end of the stick. There's only a tax on silver if it's delivered for retail purposes. But those who are buying on the Shanghai Silver Exchange, as far as I know, there's no tax relevancy here. So in normal times, the price in New York, the near-dated future, and in Shanghai, the near-dated future in Shanghai, were approximately the same. There would be $0.50 difference, sometimes $1.50 difference, but almost no difference. And if the difference became sufficiently large, let's call it $1 or $1.50, it was worthwhile the large bullion banks buying some silver at COMEX, loading it up on a plane, flying it to Shanghai, and delivering it to the Shanghai silver market the next morning to take advantage of the difference. It seems that that's not happening at the moment, and the probable reason it's not happening is congestion in the silver market.
Arbitrage only works when physical delivery systems function smoothly. As Clive Thompson explains, futures price alignment between New York and Shanghai historically stayed within about $1 because banks could physically move metal to capture spreads. When that mechanism stops, it signals logistical friction or inventory tightness, a condition commodity analysts often associate with late cycle demand surges. The same breakdown in arbitrage efficiency occurred during the 2011 silver spike, when transport and refinery capacity lagged demand. Investors should understand that pricing gaps often reveal supply chain strain before headline prices move dramatically. Next, Clive Thompson points toward transportation and availability constraints shaping price divergence.
Either they can't get their hands on the physical silver in the quantities or the shape and size they need for Shanghai, or it could be that the shipping agents, the planes which fly the stuff, all sufficiently fully booked that there's no possibility of transporting it. I don't know what's wrong, and I don't think anybody does. But the fact is that silver isn't moving anymore, and therefore we've got this the price in Shanghai rising significantly higher than the price in New York. I can have a look I haven't got it in front of me, but I can look it up on my screen if you like and see what it is in Shanghai. I'll do that as we speak. So right now, the price in Shanghai on the near-dated futures and converted to dollars is 100. I'll just bear with you for a second. Okay, today it's $92, and at the spot price on COMEX it's $86.41.
Yeah. I think it has been quite a bit higher than that, hasn't it? At point,
the difference is only $6 today, but it was up to 20-something dollars a day or two ago.
And commodities stop moving physically, price discovery begins to fracture. Clive Thompson highlights a spread that recently reached over $20 between Shanghai and COMEX pricing, an unusually large divergence for a globally traded metal. Logistics bottlenecks, refining capacity, and delivery specifications can disrupt arbitrage even when inventories appear sufficient on paper. Similar delivery stress appeared in the London Metal Exchange nickel crisis in March 2022, when physical settlement risks forced market intervention. For investors, transport constraints can matter as much as supply itself in commodity pricing cycles. Next, Clive Thompson addresses whether manipulation narratives explain these market distortions.
Yeah.
But $6 is still a big difference. It shouldn't be as high as that, which implies that people are not able to get their hands on spot silver in COMEX to deliver to Shanghai, or there's something not working at the moment.
And what about this talk that the silver market has been manipulated by the big banks? I guess some might call it a conspiracy theory, but the narrative was that these big banks had manipulated the price and suppressed the price for quite some time, and now they're kind of losing control of this market. Is there any credence in that at all?
Well, the internet is awash with allegations like this, but I'm waiting for someone to produce some concrete evidence. Obviously, we've had some court cases where certain very large banks have been accused of and found guilty of manipulating the gold market or the silver market, let's say spoofing the price and things like that. Those are very old cases. But the fact is, whilst there's a lot of suspicion that this manipulation is going on, there's no real evidence.
Manipulation claims often grow loudest when markets behave unpredictably. As Clive Thompson notes, past spoofing convictions involving major banks did occur, particularly between 2008 and 2016, but recent price movements lack clear legal evidence of coordinated suppression. Commodity markets frequently show pricing distortions during supply stress, which can look like manipulation but stem from liquidity imbalances instead. Investors should remember that suspicion alone is not a trading signal. Evidence and positioning data matter more than online narratives. The real risk may be structural market strain rather than conspiracy. Next, Clive Thompson explains the futures strategy often mistaken for manipulation.
I think if one could talk about manipulation, and really when people are talking about manipulation, they're talking about the powers that be driving down the price. What they are talking about is really what I see as a perfectly normal money-making activity, which is quite normal for any large financial institution who are in that business. And that money-making operation basically involves selling silver futures for a future date, where typically the price is at a higher price than the spot price. So you put up a small amount of margin, you sell the future, let's say, we're talking silver, you sell the future at, let's say, $101, and then you wait the 3 months till the future arrives at the spot month, and then you buy back that future at the spot price, which will be lower, and instantly sell another future for 3 months forward. So when you get to maturity, you buy back the spot month. Let's say the spot month is now at 100. You buy back at 100, and you then sell the future for 103. And then that gets to maturity.
What many call manipulation is often just futures market structure doing its job. As Clive Thompson explains, contango pricing, where futures trade above spot, creates routine opportunities for institutional trading strategies. This rolling futures trade is common across commodities like oil and copper, not just silver, and has existed for decades within regulated exchanges. CME margin requirements, often around 10%, allow leverage participation, amplifying returns, but also risk. For investors, understanding futures mechanics prevents misinterpreting normal hedging activity as market control. Next, Clive Thompson shows why this strategy stops working during rapid price rallies.
And there's always going to be this difference, that's the view, there'll always be a difference where you're selling something in the future for more than it costs in the spot. So it's free money. Anyone in theory could do it. Obviously you've got to have very low cost, low frictional cost to do this, but you constantly sell the future at the higher price, and when it gets to spot, you buy back what you sold and sell another one, start again. You keep rolling, making constant money. And since you only have to put up a small amount of margin, let's say 10% of the value of the silver, you're making quite a nice large percentage gain on a very small amount of money which you've got tied up. And that money which you've got tied up is also earning for you because you've got that invested in treasury bills. So you're earning twice over. Easy money, nice and free. But the problem arises when the silver price is rising very, very fast, because then what happens?
Free money. Strategies usually work only until volatility changes the rules. Clive Thompson describes how rolling futures positions can generate steady returns during stable price periods, similar to carry trades in bond markets. But history shows leverage strategies struggle during sharp commodity rallies. The 2011 silver surge and 2022 energy spike both triggered margin stress across institutions. When volatility rises, financing costs and collateral demands increase rapidly, turning low-risk trades into liquidity challenges. For portfolio investors, this explains why institutional positioning can suddenly reverse during rallies. Next, Clive Thompson explains how rising prices force margin decisions.
Your 10% margin, if the silver price was $25, your 10% margin is only $2.50 per ounce. But if now it's at $100, your margin is 4 times as much. You've got to come up with a lot more cash. And that's great if you've got it, and most large institutions do have it, but it might be inconvenient because it's not something you planned on, and you might have redeployed that cash in another one of your businesses or activities. And therefore the question would be, do I curtail the other activity I'm in to provide the cash for the COMEX margin, or do I reduce my exposure to the futures by, when it gets to maturity, buying back and not rolling into the future month? That's the dilemma. But all of that creates, to the extent you decide not to do as much as you used to do, and you might not want to do as much at a higher price because that means your risk exposure is getting higher, that means that you become effectively net buyers.
Rising commodity prices can quietly force institutions to become buyers even if they don't want to be. As Clive Thompson explains, margin requirements scale with price levels, meaning a 4-fold price increase can demand dramatically more collateral from future sellers. Similar margin-driven repositioning happened during the nickel market crisis in March 2022 when brokers demanded additional capital from traders. Liquidity pressure, not bullish conviction, often drives these buying flows during commodity rallies. Investors watching silver should monitor leverage conditions as closely as supply data. Next, Clive Thompson connects this behavior to broader investor strategy decisions.
But is it manipulation? I don't think so. I don't call that. I just call that normal business activity of making money. If you could find something you could sell at a high price where you could buy it back today at a lower price, and all you've got to do is wait a month to make the profit, well, why not?
So what about the silver miners then, Clive? In the current environment, are they still attractive?
None of the factors which were driving silver higher, or gold for that matter, have gone away. All of those factors, the geopolitical story, the debasement story, the tariffs, the political uncertainty, the levels of government debt, the central bank buying, all of these stories are still around. Nothing has changed in terms of the narrative. All that's changed actually is the price. And one of the things I think which did change and became a sort of new narrative as we went into late 2025 was the behavior of investors. And I talk more about gold here than silver, but obviously the same applies to silver.
When narratives stay bullish but prices fall, investor psychology, not fundamentals, is usually the missing variable. As Clive Thompson suggests here, macro drivers like central bank buying and government debt expansion didn't disappear in 2025, yet silver corrected sharply anyway. The World Gold Council reported central banks bought over 1,000 tons of gold in 2023 and remained strong buyers into 2025, reinforcing the long-term thesis. What actually shifted was positioning. Investors taking profits after a major run. For portfolios, this highlights the difference between structural demand and short-term liquidity cycles. And what he implies next reframes how investors should interpret volatility during long-term bull markets.
If your portfolio, when you look at it, is a sea of red, minus, 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 what are you? You're a lousy investor. So how can you ensure that you think you're a good investor and everybody else thinks you're a good investor? Well, the way is very simple. When you have a winner, never sell all of it. So let's take the example of silver. It's now 3 times the price it was. You want to take some profits. Don't say, gosh, it's so high, I've got to sell it all. Sell a little bit. Sell 10 or 20 or 30% of it. So you've got some money to do something else with, but you've still got this nice position in your portfolio with a big plus sign. Now you can buy something else. What about your losers? Let's say you've bought silver at 120 and it's now 100. I don't mean it could be silver, it could be anything. Well, first of all, you should always let a certain amount of time pass. You shouldn't jump to a conclusion a week or a month after you bought something. So let some time pass, 3 months, 6 months, a year. But over time, and I do this. I hold everything for more than a year.
The biggest portfolio mistakes rarely come from bad assets. They come from emotional timing decisions. Clive Thompson is describing a disciplined professional portfolio managers follow, scaling out of winners instead of exiting entirely. Dalbar studies consistently show retail investors underperform the S&P 500 by roughly 3 to 4% annually due to timing errors. Selling 20% of a position after a 200% rally locks in gains while maintaining exposure to trend continuation. The one-year holding rule also reduces tax friction and reactionary trading after Fed announcements or earnings cycles. Next, he explains why patience often matters more than prediction in portfolio performance.
That's my time frame. It's a mental discipline. Even if I desperately want to sell something, I will not do it in the first year. Because I believe that too much activity creates friction, and friction creates losses. So, and during the course of a year, there will be good news, bad news, good news, bad news, good news, bad news, good news. So, let's say there's 4 bits of good news and 4 bits of bad news. That means there's 4 opportunities for me to feel bad, and I'd sell it at a low price. I like to avoid that. So I like to let a decent amount of time. So when you're selling, and you have a portfolio of things, look for the things you've held for a long time and find a reason why you got it wrong. If you can find that reason, and if you look hard enough, you probably will, you should be selling it. So most of your losers, you'll find what you did wrong and realize you got it wrong, you should be selling. Most of your winners, you can, if you want to, top slice, but you should be keeping them. What does this do to your portfolio? It means after a period of time, you've got far more winners sitting in your portfolio because you sold most of your losers.
Portfolio turnover quietly destroys returns more reliably than market crashes do. Clive Thompson is pointing to frictional loss, commissions, spreads, taxes, and timing mistakes, which Morningstar estimates can reduce investor returns by over 1% annually. The discipline of holding through a full information cycle, so earnings reports, Fed meetings, and macro shifts, prevents emotional selling during volatility spikes. Selling losers only after identifying a broken thesis forces analytical accountability instead of panic. Over multiple cycles, this naturally increases portfolio quality and trend exposure. And what suggests next shows how compounding favors disciplined investors over reactive ones.
They're not there anymore, and you're going to feel much better. So every time you buy every time you raise some cash by top slicing the winners, selling some of the losers, you've got cash to reinvest. You reinvest that in other things. Half of those will go up, half will go down. And a year later, you're going to keep the half which went up, and you're going to get rid of most of the half which went down. And eventually, over time, you have a portfolio where you've got 80 winners and only 20 losers.
Yeah, so it's a very interesting framework, that Clive, because I think it's something that most investors really struggle with, especially kind of when it comes to cleaning out all the losers from a portfolio. Because I think a lot of people think, well, it's gone down, it must mean that I need to buy some more, it's cheaper or whatever. And I think the all the research shows that you should back your winners and prune your losers. But I just wonder, Clive, given how the recent volatility in silver and the incredible run that we've had, is there anything that you've learned from this period, that you might be able to kind of share with people?
Averaging down feels intelligent, but statistically it often compounds mistakes. As Clive Thompson describes, pruning losers and reinvesting into strength mirrors momentum-based portfolio strategies used by institutional funds. Research from AQR shows momentum has delivered persistent excess returns across asset classes for decades. Investors often confuse cheap with recovering. especially after volatile commodities rallies like silver in 2024 to 2025. Reallocating capital toward confirmed trends improves portfolio resilience during liquidity tightening cycles. Next, he reflects on what the recent silver volatility taught even experienced investors.
Well, I suppose we all learned a lesson that we should have sold at the top, right? When I looked at my chart, it looked like it was right. You got your chart there, and it was right at the top. Well, there's obviously a ceiling; can't go any higher. Except 6 months ago, it looked like it was at the top too. There's no lesson other than if you need to raise cash, don't wait for higher prices. When you know you need the cash, take the cash off the table because you don't know what tomorrow's price is going to be. But if you don't need the cash, there's not really a reason to sell. You should sit through these declines, provided if you've got too much in the if from a position sizing point of view. So position sizing means an asset class shouldn't get beyond a certain level, and what that level is called asset allocation. So if you work with somebody who's in wealth management, they'll tell you you should have this much percentage in bonds, this much percentage in equities, this much in gold, this much in silver, this much in Bitcoin, this much in property, this much in collectibles, and they'll go through a list of private equity and other things.
The idea of selling the top sounds smart, but it's mostly hindsight illusion. Clive Thompson highlights a core investing truth. Liquidity needs, not price forecasts, should drive selling decisions. Vanguard research shows asset allocation explains roughly 90% of long-term portfolio return variability, far more than market timing. Position sizing protects investors from emotional decisions during commodity spikes, like silver's surge into late 2025. When one asset grows too large, risk rises even if the thesis remains intact.